Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening. Check out the Mortgage Voice podcast on Apple Podcasts and Google Music Play, or wherever fine podcasts are heard. Subscribe for free and never miss an episode. And please leave us a review. Hey, it helps us find our show. It helps others find our show. The more people ask questions, sign up, hit the bell button. Yeah, all these things help us with the show, and of course we love the feedback. We're also on YouTube at Jeff Barton, the Mortgage Voice. Subscribe to the channel, click on the bell as I just said, and get notified whenever a new episode is available, and they are available usually weekly. So the new information, the mortgage market changes all the time. Economics, the economic outlook, the way we are integrated into the overall scheme, i.e. mortgages, mortgage rates, how you get a mortgage, whether you qualify, the new rules by HUD, the new rules by FHA, all these things are affected. And I think if you're out there and you're thinking about getting a mortgage and you're thinking about all this stuff, this is the place you want to be. Check us out on our website at www.themortgagevoice.com. And again, I'm Jeff Barton. Thanks for listening to the show. I saw an interesting article. There's a magazine that comes out. We've talked about it on the show. It's called The Scotsman's Guide. Now, why I bring the Scotsman's Guide up, it's like a trade magazine, but essentially what it does is it lays out a lot of different lenders in there, whether it's commercial, whether it's real estate, or any other kind of business loans. And usually there are listings in there of different lenders and what the criteria are for those particular lenders for you to get a loan. In order to get a loan from those particular lenders, and in order to understand how much money you can borrow and the specifics, you're probably going to need to talk to a mortgage banker or mortgage broker or somebody at the bank. All of these are solutions that you can bring to the table. But I saw today, and what I thought was interesting, is they occasionally do articles about cities, about areas, about what's going on in a particular town. This is a national magazine, and lo and behold, here we are. We're talking about a terrific city in Riverside, California that made Scotsman's Guide's interesting list. The Golden State still has strong economic fundamentals. Well, that's true. And I got to tell you, I don't know whether I'm happy about it or sad about it. And I'll tell you why. I run a small business, right? I run Malibu Funding. Malibu Funding sponsors the show. They spend the dough for me to get on the air. But I run the company, and every day is another set of problems. Normally, the problems are either twofold. They're either about a customer who is complaining about something or needs something done immediately, or it's a regulator telling me I have to do something. Well, we usually run about 50-50 with that kind of thing on a yearly basis. But at the beginning of the year, the regulators take over your life. The requirements to stay in business as a small-time lender are a lot. And so if you run a small business, you know what I'm talking about. And if you run a small business in Southern California, San Bernardino, Riverside counties, for instance, you know what I'm talking about. Whether it's the local, building inspector coming into your business to make sure that everything is squared away according to the local ordinances, or whether it's the state telling you, okay, it's that time of year, you need to pay up, or you need to do something or report something. So this is what's happening. And this is what's happening in Southern California. It happens all over the place. So I get sick of it, and I'm tired of it most of the time, especially this time of the year. But this great article about Riverside County talked about the future and what's coming in the future. And what they talked about is how Riverside, the city of Riverside, is poised, and the county of Riverside, to become one of the top 15 to 20 metropolitan areas in the U.S. And they predict that in another 20, 25 years, you're going to have 7-8 million people living in that county. Now, for those of you who don't know the current or don't know what the surrounding areas are, Riverside is obviously the people who are listening to this know exactly what I'm talking about, but those in other states that do not, those in other areas who are listening to the show who do not, it is east of the ocean and east of Los Angeles. It's nestled between a couple of counties, San Bernardino on one side, Los Angeles on the other. To the south, we have Orange County, and of course, to the north, we have the 15 going off to Vegas and all the terrific counties and cities along the highway out there. It's a terrific old place, been around a long time. And some of the statistics that they were talking about, current statistics, they have an unemployment rate of 3.9%. Now, anybody who was around 10, 15 years ago, 15 years ago was very similar to the way it is, although real estate prices were less and the employment wasn't as great. However, 10 years ago, we were in the midst of a horrible recession, maybe just coming out of it now in 2010. It's 2020. 10 years later, we've got an unemployment rate which is unbelievable. I believe the unemployment rate in Riverside County during the recession was closer to 11, maybe even 12%. Now, to come back that far and see real estate prices rise and employment rise and people really doing well in Riverside County is a great testament to California. And I said, I'm mad at California and I'm happy about California. And if you're a small business owner, as I said, there's reasons for that. My particular reason is California has proposed a CFPB-like structure for a new government regulator in the mortgage business or in the financial services business. Now, what does that mean? The CFPB is an organization that was mandated or authorized by the Dodd-Frank Act back in 2008. These are Barney Frank and Chris Dodd. They were Democrats at the time, and they got together and forced through, based on Democratic winning, Obama winning the White House and the Congress were in Democratic hands, and they pushed by this lengthy and very stringent regulatory framework for the financial sector. Among that was the mortgage industry. Well, since that time, the country's done well, the mortgage rates have been low and have stayed low, and we are now in a completely different situation. So what happens if the Trump administration has, what has happened is the Trump administration has loosened some of the regulations, and they have browbeaten Jerome Powell into several rate cuts last year, which a lot of people have said has really helped the mortgage industry, has kept mortgage rates low, even though it's not necessarily a one-on-one situation, but it's symbiotic in nature. So we have low interest rates, we have a cowed Fed, i.e. that they're, like a lot of people, afraid of the current administration. So what has California done, and what does California normally do? They usually go their own way in many different respects, whether it's sanctuary state or whether it's in Los Angeles County, it was, $2 billion to house 50,000 homeless people? I think that was the tax they put in place to do that. But now they're talking about Gavin Newsom, the governor of California, instituting California's own CFPB, their own regulatory board, because the Trump administration has loosened the standards and somehow somebody thinks that it's a problem for consumers. And so if you are a consumer out there and you have a problem with somebody that is screwing you over, either in a loan or some financial transaction that is beyond your capacity to pay for a lawyer, and do you think that this kind of regulation is going to help you? If you do, email me, malibufunding@yahoo.com. And why do I say that? Because I don't know who are these people getting screwed over. The economy, and as I said, unemployment rate in Riverside, 3.9%. Annual GDP growth, 1.9%, which is bang on what the national GDP growth rate is. The population in California is 39.6 million. Actually, we lost about 1 million people last year. We're going to lose a congressional seat, too, through the next census, which happens this year. Anyway, so what's good for Riverside, what's good for Southern California, what has been good and what has been happening as good information and good times since 2010 is now about to be once again upended by the people who know better, the elected officials who think that somehow somebody's getting screwed in the time where it's probably the best economic situation California's been in since Reagan. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and thanks for listening. Check out the Mortgage Voice podcast on Apple Podcasts and Google Music Play, and wherever fine podcasts are heard. Subscribe for free, never miss an episode, and please leave us a review. It helps others find our show because we get pushed up on all the lists, and everybody is happy with that. We're also on YouTube, Jeff Barton, The Mortgage Voice. Subscribe to the channel. Click on the bell to get notified whenever a new episode is available. Yes, that's right. Ding dong means yes. The ding dong me will be able to get in front of you more quickly and to get more information. Check us out on our website at www.themortgagevoice.com. All kinds of different ways to be able to see, hear, and get information from the show. Really appreciate you listening today. Let's get right to it. A little bit of news to use. There's always an argument, especially in today's world, when we're talking about millennials or Gen Xers or the people that are coming next, and there's that group from 3 years old to 18. Is that the next group coming up? Darryl, do you know?
I think so.
Yeah, and they were talking about this upper end of the group, i.e. the 18-year-olds, are the first time getting into their first jobs. And there was an interesting statistic. Now, I'm 65, soon to be. And so my idea of work and my idea of leaving work to go get another job or retire or just whatever is quite a bit different than this new group who are just entering the workforce and the millennials who are the Gen Xers who are the next group in line. And the interesting article was this. It said that the baby boomers, my group, found that if you're going to leave a job, that only 19% of those people would just walk out the door and never look back. Meaning that, like myself, I would give them 2 weeks' notice. I would make sure that I would do my job to the best of my ability right up until the day I walked out the door so that I would have, whatever internal pride that was, but also that I thought I owed the company something. Not this new group. What?
Well, I mean, our group, the boomers,
right,
thought continuity was important.
Absolutely.
As far as jobs are concerned. And the 18 to 25-year-old age group is Gen Z.
Gen Z.
And the Gen Alpha is a 1 to 7, which they probably don't have a lot of influence.
Not yet. Okay, thank you for that. The article reading, it said that this new group, only 50% thought that was something that they would do, meaning that 50% of this group would just walk out the door and just say, hey, see ya, I'm gone. Not even that. They just never come back. Now, that's an interesting twist in how employment is seen, how people see going to work. And now maybe that's the effect of, I don't know, social media or the everything is about me kind of outlook, because I think there's a lot of that going on today.
And a lot of the employers are accommodating for it. My stepdaughter went to work at Amazon this last week.
Right.
And
great.
they can schedule their time. They can pick days. They can go add and subtract and go back and forth. And if they do something bad, they get little dings. And just after a certain amount, they're terminated. But it's a whole different. A computer makes all the decisions at this point.
That's interesting, and I've heard of that kind of scheduling as well, whereby you do everything on your cell phone. Your hours, you report your hours, you report any issue. Your direction comes from the cell phone.
Yeah, but after less than a week, she's taking a day off, right? I would consider that to be, employment suicide. But these guys are used to it.
Yeah, I don't know. Anyway, let's look at a couple of things that affects, right? So this new group are renters, by and large. And the difference between renting a home and buying a home, okay, it's very similar to the mentality of the workplace environment that we've just described. People who rent because they think it's cheaper than buying. It's simple. Or they don't have the down payment. But there are so many loan programs out there right now where you don't even need a down payment. The DPA programs, down payment assistance, there are several. And there's a Chenoweth program. Anyway, if you need information on that, call the office and we'll set you up with a loan officer and walk you right through that. The days of renting being cheaper than buying are so far behind us. You look at some of the rents that are being paid versus what you can buy for a similar number of mortgage being paid, and you'd be shocked. 50% of the renters could buy right now. There is a huge pool of renters out there, or maybe it's impermanence. Maybe they just don't want to commit. Right? I think mortgages mean that you're old or you're committing to something that maybe you're not quite sure of. Well, what do you think the psychology of that is?
Well, I think a lot of people think once you buy a house, you're tying an anchor around your neck, you're not going to go anywhere. Thus, these mini houses that you could drive around from place to place,
right.
It's just, being mobile, portable, and expendable and choosing to be that way is a big thing.
I guess so. I mean, there was a generation way back in the day that thought that the world was going to end, and they all lived in Paris and wrote beautiful books and painted beautiful pictures. And that particular group, Jean-Paul Sartre and Ernest Hemingway and whoever else was in that group, there was a ton of them. And I forget what they were called.
The Lost Generation.
The Lost Generation, okay. Well, I don't think this generation can claim that. I just think this generation has issues with trying to figure out what they're going to do next, and somebody else has to take that responsibility, just not them. So renting becomes something that is either easier or just something that lends to what you were saying. I can get out. I don't have to be here. I don't want to be anchored down. But let me tell you something. If you're out there and you have a job and you can afford the monthly payment, you're already paying the rent. Buying something is something that keeps the dream of one day being able to not work alive. Nobody wants to work right in your generation. Let's face it. Nobody is ambitious as the people of the generation before mine, which were, of course, the Depression era people. Those people were motivated. World War II, they came home, they built America. All the rest of it is gravy. My generation, not as motivated, but kind of motivated. Then it kind of drifted down to where it is today. But to get to retirement, to get to the age that I am now, if you're 21, 22 years old, and I know you're not thinking about it, or 25 to 29 years old, where I have children, if buying a house isn't the way out, what is? If buying something and have it paid off over time, whether you live there or you rent it, is not the way to financial freedom, what is? Because financial freedom is what you're going to need to retire. Because Social Security, let me tell you something. Anybody looked at Trump's last budget or whatever numbers he threw out? Those are getting cut. Medicaid's getting cut. All the entitlements getting cut. And why? Because the difference between raising the deficit and having the deficit take over the budget is entitlements. If we cut entitlements in half, there wouldn't be a budget deficit. Why? Because it's the biggest money spender outside of the Defense Department in the budget. And it, because of the baby boomers, is going to rise significantly in the next 10 years. When I'm 65 now, when I'm 75, all of the baby boomer generation will be over 65 years old, which means that you've probably got, how many is it? 80 million, 180 million? It's some huge number.
Yeah, I don't have that on this chart, but yeah, it's large.
It's a big number. And we're all living. Why? Because we can afford to live. I mean, we can basically get the best medical care. Most people eat well. They're not starving. They don't have, they have the diseases of luxury, right? Diabetes, obesity, hypertension. All these things are because we indulge too much, we eat too much, we don't get off the couch enough. And all of those things, yes, will take their toll. But our generation is huge. It's going to suck up a lot of money. So if you're out there and you're young, and I'm talking below 30 years old, even below 50 really, but below 30, and you're not thinking because like most people you believe renting is cheaper than owning, it's not. You need to think about the future and where you're going to be when you're my age. And the only way to really get there is if you own property and get it paid off so you have a large asset which you can draw on when you retire. I'm Jeff Barton. I'm your voice in the mortgage industry. I really appreciate you listening each and every week, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. Thank you for listening. Check out the Mortgage Voice podcast on Apple Podcasts and Google Music Play, wherever fine podcasts are heard. Subscribe for free and never miss an episode. And please leave us a review. It helps others to find the show. We're also on YouTube at Jeff Barton, the Mortgage Voice. Subscribe to our channel and click on the bell to get notified whenever a new episode is available. And by the way, ding, one will be coming up this Saturday. Also, check us out on our website, www.themortgagevoice.com. You can see us there. We have a number of different things that we wanted to talk about today. On the show, we've talked about what's going on in Riverside County, a little bit about the rates, and I wanted to talk some programs, and I brought to the show Kim Soash from Homebridge, who has been on the show, and I want to welcome her on the show now. Hi, Kim.
Well, hi, Jeff. Thank you for having me. I appreciate it.
Thank you very much. Thanks for coming on, too. Okay. We're kind of in full swing here. Low interest rates, good climate for buying. It looks like we've got a tight housing inventory, but prices aren't rising as fast as they have in past. I guess in 2004, 5, and 6, they really went up quick. They're only going up about 3.5% a year now. So it means that people should be buying or refinancing. Tell us about a program or two that you might think could apply to some of these borrowers.
Well, one of the things that what's been nice was the change in the loan limits. It was nice to see the loan limits go up a little bit for certain of high cost areas. So that's a little shot in the arm for people. Some of the things that have been popular for folks have always been things where they're self-employed borrowers and they really can't show all their income. So having products available out there for people that can qualify only on their bank statement income or only use one-year tax returns gives people some flexibility. Maybe the year before wasn't that great, but last year's income was good. So just qualify on that most recent income, so that's helpful. And then people that are interested in getting into the non-owner market, getting a rental property. There's products out there now that really treat the loan almost as if it were a commercial loan. And you qualify only on the income of the rental property. So that's a no-doc loan. You don't have to show any income as long as the as long as the rental income is more than the PITIA, the principal, interest, tax, and insurance of the mortgage of the property, then the borrower qualifies, and that's it. No debt ratios, no reserves if it's under 80% loan to value. It's a very clean and easy loan for
Kim,
people that are wanting to invest in properties.
Let me ask you a question on that. Okay, so the ability to repay rule, a Dodd-Frank important thing, the ATR, it requires that there is proof that the borrower can pay. This loan is not about the borrower repaying. It's about the property being able to cover the debt or the mortgage service. How do they get away with that?
I think that the way they're getting away with it, Jeff, is because it's being treated as a business loan. It's being treated like it's an investment property and it's a business loan, so it's skirting the guidelines that apply to a personal residence or a second home.
I see. I love the loan, by the way. And when they started coming out and when you were talking about it on a different show, I just think it's a way by somebody who may, be skittish about, can I afford this mortgage? Well, it's not you affording it. You're just getting a renter in there to pay for the mortgage, and that's how you're qualifying for the loan. I think it's a terrific loan. Have you seen a lot of people obviously excited about it, but taking advantage of the program?
Oh, it's ridiculously popular. It's a real popular loan. And it's funny because there's even borrowers who are, it's not about credit or tax returns. I mean, they could qualify full doc, but there's people that have 15, 20 properties they don't want to. They don't want to bring in a wheelbarrow full of tax documents. They just want to qualify for this one home, or 8 of them have financing, and the other ones don't, and they just want to refinance. It's just easy. It's a real easy loan. You'd be brokers and loan officers are always delighted at the small list of conditions that go with a loan like this, because there's really not a lot of moving parts.
Well, that's a good point, too. Less documentation is always a welcome thing. Now, one of the downside of this is the rate's got to be a little higher, right? And also, how much money do you have to bring in?
Well, the rate's higher, and it depends. If you're doing a purchase, you could, depending on your credit score, get as much as 15% down, so 85% loan to value.
That's not
bad. It has
bad.
great flexibility. The max loan amount is $3 million on this thing.
Wow.
You can get cash out. All the money can be cash out. You could even at 80%. It kind of moves. The higher the loan size, like $3 million doesn't go to 80%, but
right.
But like 80% to $1 million.
Right.
You could do cash out. So it has a lot of flexibility. It's been real popular. And the rule of thumb is that the rent needs to cover your principal, interest, tax, insurance, and homeowners if it applies.
Uh-huh.
But there are instances when it doesn't have to cover. So when it can be a little bit, when it's not quite covering. So you might have a loan to value restriction on that where you can't go as high on LTV, but still you're able to get a loan done without the rent quite almost just it's mostly covering the principal and interest and tax and insurance, but not quite all.
Now, the economy is doing well, right? That's what everybody says. And obviously it's reflected in the type of loan programs that are available now that were not available even as little as 3 to 4 years ago. Do you think that these types of programs are indicative of the strength of the economy, or is it just the opposite? Is it something that we need these types of loans in order to keep the churn going on loans in the business? Because that's what the problem was back in 06, 7, and 8. They just made loans so easy to get that everybody was keeping the ball rolling. Which is it, do you think?
Well, it's probably a little of both. I think that it takes, there's always a giant correction, and it seems like the pendulum swings. It was way one side for being very loose, and you almost only had to have a pulse to get a loan done. And then the correction swings way the other way, where it's making it almost impossible. And so I think that time has passed, where it comes back to where they realize there's still sophisticated borrowers out there, borrowers that are fully capable of repaying a loan. And I think that this appetite for a little bit looser guidelines comes with the strength of the economy and also just I think confidence in the market. It's nice to see these things come. Another thing we introduced recently, it doesn't have huge call, but I get a few phone calls on it. We never could do foreign nationals before, and now we can do loans for foreign nationals. They've made some changes to even DACA status borrowers. So I think realizing that we have a different climate, we have different borrowers out there, and opening the market to some of these folks is it's certainly good. It's good for our industry. It's good for the borrowers. It's kind of win-win for everyone.
Well, it's interesting. We make a big deal, especially about building the border wall between here and Mexico. But I'll tell you, in Florida, there are huge numbers of people who fly into Miami from South America and buy property. I know because we have a loan officer down there who's Brazilian, and he sells loans all day long to Brazilian nationals to come in with ITIN numbers. So this particular product may not be, the most popular here because there's such a spotlight on what's happening or what isn't happening, and everybody's nervous, so nobody wants to, commit to lending. But in other states, in other places, in other areas where it isn't as strict and the light's not as shining as brightly, like a Florida with my Brazilian friend and my Brazilian clients that come in, the foreign national product is really great. And we really appreciate people when they take advantage of it. And obviously, Homebridge is another example of a company that'll do them.
Yep. So that's been a nice addition to our portfolio recently. That's probably one of the newest things that we launched is doing the foreign nationals.
That's excellent. Hey, Kim, shout out your phone number for people who are listening to you and want to hear more about the programs you're talking about directly from you.
Oh, 818-970-4016.
Excellent.
And it's Kim Salash at Homebridge.
Kim, thank you very much once again for coming on the show. You always illuminate, and I really appreciate it. Thanks.
Well, thanks, Jeff. I love being on the show, and thanks for having me.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening. Thanks for tuning in. Check out the Mortgage Voice podcast on Apple Podcasts and Google Music Player, wherever fine podcasts are heard. Hey, subscribe for free. Never miss an episode. And please leave us a review. Why? Because it helps others find the show. The more people that get involved, the more people will hear what we're doing. And I think what we're doing is a service to the lending community. We're also on YouTube. Jeff Barton at The Mortgage Voice. Jeff Barton, The Mortgage Voice is our YouTube channel. Subscribe to the channel. Click on the bell to get notified. Ding! Whenever a new episode is available. And check us out on our website, www.mortgagevoice.com. We're also on KCAA, KMET, and K-Tahoe, 3 great radio stations that have been, I guess, housing or broadcasting the show 5 times a week for years now, and we really have a terrific audience in the San Bernardino Riverside area as well as up in the Tahoe area. We are going to bring on a couple of new stations soon enough, and I really appreciate everybody who helps the show grow. And again, thanks very much. I'm Jeff Barton, the voice, the Mortgage Voice, and I wanted to bring to the show, we try to get experts from different fields, certainly in the lending world. Different products and things that are available out there are not always known to people who listen to the show. So Lori Preach from Spring EQ is on the show, and she's going to tell us about what the heck is going on over at Spring EQ. It's an interesting company, and they do some loans that you might not know are still available or are available. Lori, how are you? Sorry about that long interview.
I'm great, Jeff. How are you?
I'm fine. Thank you very much. Okay. Seconds, tell us about what you do in order to, get your business and how you help consumers buy loans and what you do with your seconds. I really appreciate you coming on.
Well, yeah, thank you for having me. So Spring EQ Home Equity offers a unique product in the marketplace. We offer a fixed-rate closed-end second. It's fully amortizing, and it's a great product to help consumers eliminate their consumer credit card debt because most people only make their minimum payments on those credit cards, and they never really get rid of them. But by consolidating all of that debt onto a fixed-rate second mortgage, they'll eliminate their debt over time by fully amortizing that payment out, and the rate on it is much, much lower than what they're paying on their credit card. So that's the number one use of our product at the current time.
And how does one qualify for that? Obviously, if someone owns a home and they have a mortgage currently on that, how does this particular product fit in with what they already have?
Well, since the product is a 30-year fixed product, the first mortgage lenders don't have a problem with us putting a second mortgage behind their first.
Okay.
So we do have to look at the total mortgage balances versus their value of their home. And at Spring EQ, we will actually go up to 100% of the home's value. So for easy math, if they owned a home worth $100,000 and they owed $80,000 on their first mortgage, we could give them a $20,000 second to help pay off that debt or build a pool or pay for college. Any of those uses are perfectly fine with us.
Mm-hmm.
If they go above the 95% of what their home is worth, their first mortgage lender would not do it concurrent with our loan, but they could do it separately away from their first mortgage. Does that make sense?
Yeah, it does. I guess what you're saying is, do you do these loans upon purchase, or is it usually a refinance option on them?
Well, we do also do them on purchases, but not to 100% CLTV.
Right.
We'll only go to 95% of the home value on a purchase or concurrent with the first mortgage being refinanced. But on a standalone basis where they're not touching their first mortgage or during a purchase, then we would go to the 100 CLTV. So I would say we do about 30% of our business is concurrent with the new first mortgage, and then 70% is standalone seconds where they're using that money for some other purpose, and they don't want to touch their current first mortgage.
Now, Spring EQ, how long have you been around doing these type of loans? Because for a while we couldn't even find anybody who would do this or a HELOC or anything having to do with backing up the first.
Spring EQ has been in business for 3 years.
Mm-hmm.
Doing second mortgages only. That's the only thing we do. We don't mess with first mortgages, strictly seconds. And we are the only wholesale lender that does fixed rate products at the current time.
Yeah, good point. Rates on these products. I guess, do you qualify them the same way you would qualify on a first, or is there some other criteria that you use?
For the most part, it's qualified just like you would on a first. We allow up to 43% of their income and expenses in comparison to their income. So that might be more liberal or strict than a first mortgage, but overall we follow the basic same guidelines as a first mortgage lender would.
Okay, now I've heard, and you correct me if I'm wrong, that they're talking about doing away with the debt-to-income ratios, or at least in its current configuration. Have you heard that?
I have not, no.
Well, let's say, for instance, that happens, and the debt-to-income ratio that is currently, as you were mentioning, 43%. What is that on the back end or the front end?
Back end.
That's back end. And for people who are out there, it's the difference between just your mortgage payment and then all your bills. So this would be all your bills in. The 43% of that could be all your bills in. Is that? Am I reading that right?
Correct.
Okay. So if they did away with that, they would go to a basis of either some other criteria of approving a lender. How much does the debt to income and what kind of credit score are you looking at for most of your borrowers?
So our average credit score that we lend to is in the low 700s. That's our average, but we will go as low as 640. And that's using Experian version 8, which is a consumer credit card score. We do not use the mortgage score. So we're in a better, we basically have more leeway on our credit scores because of the version that we use.
I see, and that's interesting. I think a lot of the consumers or anybody who's listening to the show is going, huh? I thought I just had one credit score. No, actually there are several different products from all the different leading credit providers that will give you different scenarios based on what you include in the report, and you just mentioned one. And how is that affecting the rate by which you're charging on the second?
Well, our rates vary depending on your credit score. So 700 and above credit scores have a different rate than credit scores below 700.
Right.
So if you were to go to your bank and try to get a second and they're using the mortgage scores and then we're using the consumer credit scores, we may have a 710 where the bank has a 680. So that's what our score is a big advantage. It's a much more liberal score.
Yeah, no, and I like that too. And because of that, obviously you're finding more borrowers coming to you than would go to necessarily their bank at the corner to get a HELOC. And HELOCs are quite a different product than a second, right?
Correct. Yes, a HELOC is basically the credit card against your house. So with the credit card, you're only making interest-only payments just like you would on your credit card, and therefore your debt never really retires. And usually after a period of about 10 years, the bank's going to come back to you and want you to start paying back the principal, or they'll eliminate your use of the line of credit any longer. So ours is a much safer bet for a consumer because it's fixed, it won't adjust, and they are retiring their debt.
Excellent. Okay, give us a range of some of the, let's say I'm a 740 FICO person and I'm borrowing, 15% of my house. There's still 5% equity in it. What kind of rate would that allow me?
Well, there's a lot of different factors that go into it besides the CLTV and the credit score. There's adjustments for condominium or self-employed, but I could say that our best rate that we offer is 4.99, and the highest rates can be up in the high nines. So it really just depends, credit score, loan amount, CLTV, the condo, self-employed.
Well, that tells me, though, that you have answers for people who have different scenarios. Like, not everybody is going to fit into the bubble that I just described as myself. Of course, it was fantasy, but that is what I was describing. I mean, some people are in a situation where they need the loan, but they aren't the most ideal candidate. So they still can come to you, although they're going to pay a higher rate.
Yes, or they would have to have a lower balance on their first mortgage. So we help a lot of people out that have a lot of equity, but their credit scores are not high enough for a bank to lend to them. So as long as they've got that 640 credit score and their CLTV or their loan amount to their house is 70 or below, we can lend to that client where a bank would tell them no.
Lori, we're up against the clock. Could you provide to the listening audience your phone number or a way to get in touch with you?
Sure. My phone number is 949-610-3379, and my email is lpreach@springeq.com.
Excellent. That is terrific. Lori, thanks very much for coming on. I enjoyed having you on last time, and this time is no exception. Thanks a lot for doing it. I know it's an imposition sometimes, but again, you've been really great. Thank you.
Okay. Thank you, Jeff.
Thanks, Lori. That's Lori Preach from Spring EQ, and you have a good day, too. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to the show. Check out the Mortgage Voice podcast on Apple Podcast and Google Music Play, or wherever fine podcasts are heard. Subscribe for free. Never miss an episode. And please leave us a review. It helps others find the show. Obviously, the more people who are tuned into what we're doing and where we are, that means more people will see us, because we just move higher and higher on the list of those things that are hot in media. We're also on YouTube. Jeff Barton, the Mortgage Voice. Subscribe to the channel. Click on the bell to get notified whenever a new episode is available, and that is every week. Check us out on our website, too, www.themortgagevoice.com. We're on KCAA, KMET, and K-Tahoe, 3 great radio stations, 5 times a week. Our listening audience is growing. I appreciate everybody. Malibu Funding for funding the show. And Daryl, of course, here, who comes every week to engineer as well as to jump in. I wanted to talk to Daryl a little bit. The pleasure principle, or the principle by which people do things either to feel good or to avoid pain. Right?
Yes.
This is a Freud thing.
Yeah, this center field. Yeah.
Exactly. So, in my opinion, what we've got facing us today in the political spectrum as well as the economic spectrum is, if you're doing well, you want to keep things the same. If you're not, obviously you want some kind of change, right? Right. Okay. So, we've got a scenario whereby mortgage interest rates are great.
Have been for a while.
Have been for a long while.
Right.
And yet, we have people decrying the state of our political life. Either you're for or against. I mean, there's nobody in the middle, or nobody who's apathetic or doesn't care.
Drastic extremes.
So how do you reconcile both of these things when you're talking to peers, colleagues, anybody in the business? Do you avoid it completely, or do you dive right in?
It depends on how volatile the person you're talking to is. I mean, I've got some people that if you got into a discussion like that would leave. Would walk out.
Would just lose it either way, too.
And so there are certain friends that I have that I communicate with where we do not talk about politics
at all. Religion, politics, nothing.
Off the table. Right?
Okay.
Not even close. Or we would have strangled the crap out of each other.
So I go to the gym occasionally. So I was there this morning. And there's always the loud people who just want to engage others by not necessarily, it's a passive aggressiveness of the way things are done. So they're talking loud about whatever political side they're on. And I again, like you, I had to get up and move.
Yeah, it's been a big week. Big couple of weeks.
Okay. So let's talk about loans for a second. So we want to get a loan. And we need to get a loan, and we need a job to get a loan, and we're in a job that we don't like, but we still need to get this loan. How far before you get up and leave that job and go somewhere else, How much can you take at that particular job before you say enough and I need another job before you really want that house, so I really need to stay at this job? And where are we on this spectrum in an economy that's so great, but the political sides are so charged up? In the old days, if you didn't like a job, you stuck it out. Why? Because that's the only job you're going to get. And you were loyal to a company, our age group, right? The boomers. We just stuck it out because that's what we were told to do.
Well, it's not that we didn't want to leave. It was nobody else was leaving their positions anywhere else, so there was no opening.
There was no and there was no flexibility. There was no potential. You just had to stick it out. You're 20, you're 30 year in, and you ended up wherever you ended up.
Right.
Today, it's not that way. However, in the mortgage industry, we still look at the way you qualify for a mortgage, the way baby boomers went to work for 30 years at the same company. So the mortgage product that most people like is that 30-year fixed at a low interest rate. Well, in order to qualify for that, you have to prove that you have the ability to repay and the likelihood that you will repay that loan for 30 years. In a scenario that I've laid out about where people aren't quite sure whether they're going to stay, they're going to go. We've got volatility. We've got a lot of movement in the job market. And many people, as I said in an earlier segment, in this current generation of workers coming up, and even the younger generation, they're just going to walk out the door. So how does that reconcile with the bank's need to get a 30-year fixed rate provable person who will stay and work and pay the mortgage? I don't know where the fit is to do that.
Well, plus past results do not necessarily predict future earnings, right?
Well, no question, but that's how they based all of the reality on getting a loan.
So we're going to give you a loan today because you're working hard.
Correct.
And you're doing that, and you've got some savings. In a year, you could go berserk. Right, you can quit the job. You could drain all your savings,
Absolutely.
And be, out there next person on Naked and Afraid.
Okay, so we're revealing a little bit about our past. Okay, that's what I would have been doing. I would have been running around in the street naked at 30 degrees below zero, right, with a beer in my hand. Exactly. But there are people who are getting loans today who are in a situation whereby they're saying, yes, I'm going to pay this loan and I'm going to pay it for 30 years. And here's the documentation that says that I'm a good risk because I'm currently working and all the things that Gerald said. But what really is the proof to these people lending you the money that you're going to be that way for the next 30 years?
None.
There is zero proof that you're going to be able to do that other than, like you said, your track record and your credit score and your job.
And they don't even make you promise or guarantee going forward, right? They don't have you sign a paper that says, I will not quit my job unless they quit me. Or
here's the thing. The way Dodd-Frank was implemented and the way they got it implemented, the banks who lent you the money, the broker who gave the application to the bank, and the loan officer who gave it to the broker to give it to the bank. All of these people are on the hook for that loan, but only for 3 years. So all of this happening and the indication that the borrower will pay whether they will or they won't, 5 years into the loan, the borrower or the economy takes a dive, literal dive, and nobody's paying that mortgage, and it goes into 30, 60, 90 days late, and now it's in foreclosure. The federal government is on the hook for it. You, the taxpayer, are on the hook for it. Now, all of these files are then audited till they can find a period that's not in the right place so they can claim fraud, and then they can come back after the bank, after the broker, after the loan officer. But it was the only way that they could get Dodd-Frank, which is the massive regulation that was gone on since the crash in 2008, passed. And even with an all-Democratic Congress and presidency, executive branch, you still had to give the carrot to the banks, saying, hey, you're off the hook after 3 years. What happens? The banks get the loans from the broker, from the loan officer. They sell it to Fannie or Freddie or to Ginnie, who does the FHA side, and then they're done with it. So if, in fact, there is fraud on that file, after a certain time, yes, it can come back. Otherwise, if there's a default and no fraud, hey, it's going to be on You and me, the taxpayers. Now, why I bring all this up and why all this matters to us is that we are at the longest financial and economic expansion in the history of the country. We are now riding a wave that started back in 2010, and it has been going steady and strong ever since. During the Obama years, now during the Trump years, it has just 1.9 to 2.4% every quarter. It just keeps chugging along. One day it's not. But if Jerome Powell is correct, the head of the Fed, he said, we are in a very, very good place right now economically. If you're out there, you've heard some great solutions today about loans you can get on income property. Loans that means that you don't have to qualify, the property qualifies based on the rent that it's going to get. If you can get into one of those properties, that's a great way to really protect yourself against the future. Because one thing's for sure, people are going to need a place to live, good times or bad times. So that house or place that you want to buy and rent out is probably going to still be rentable when and if we have a recession, and it's probably sooner than later, within the next 2 or 3 years. And yeah, that's my prediction. Anyway, I'm Jeff Barton. Thanks for listening to the show. We're here each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.